Hello, my name is Russell Moore. I'm an independent VAT consultant used by the RFU to advise community clubs on VAT matters. And this session today is specifically aimed at ensuring clubs do not fall foul of the recent VAT problem, which is due to COVID specifically. So the particularly important where clubs are incurring VAT either recently or currently on facility improvement projects, so within the last 12 months. Steps can be taken by clubs to overcome these problems, and this session will look at what the problem is and how we can overcome it and the specific steps that need to be taken. So there are 4 key aspects to the talk. The first one is a bit technical, and that is looking at what the rules are in brief, which will enable us to understand how COVID is impacting upon these rules. Thirdly, we'll look at why this is particularly damaging to facility improvement projects where larger amounts than normal of VAT are being incurred. Fourthly, we'll look at the action that clubs can take now and need to take now in order to overcome this problem. And then finally, we'll go back and summarise what all these issues have been about. So the first bit, all about partial exemption. The reason this is important is that it determines how much VAT a club can recover. Clubs are termed as being partly exempt because their income is a mix of taxable income and exempt income. That's taxable for VAT purposes. So taxable income that clubs generate and liable to VAT will be things such as bar, catering, merchandise sales, kit sales, international ticket sales. That is a club's taxable income. The club's exempt income will be mainly its playing incomes, so things such as subscriptions, playing subscriptions, match fees. Those will be the main exempt incomes. So what clubs are required to do under these partial exemption rules is to establish where VAT the club incurs falls into those 2 categories. So it's either taxable input tax, that's VAT incurred on cost that relates solely and specifically to taxable activity. And on the screen, we can see that would be things such as wet bar purchases, because bar purchases can only relate to taxable sales of bar sales. It's therefore termed as taxable input tax. But also things such as catering costs, merchandise, other goods for resale, and international tickets bought from the RFU. So input tax on all of those items will be termed as taxable input tax, and clubs are allowed to recover that in full. Going to the other side of the coin, clubs also need to establish what VAT has been incurred on their exempt related purchases. So things such as kit and equipment bought and given to players is a benefit of the player's exempt subscription and therefore will be exempt input tax. Also direct playing costs, things like medical, physio, first aid costs, directly relate to playing and therefore will be exempt input tax. Fundraising event costs, where the fundraising event is an exempt event and VAT is not declared on the income, any VAT on related purchases such as wet bar purchases or a marquee or a band will be exempt input tax. Also minis and juniors entry fees, where minis and juniors side is sent off on a competition or another entry, then any VAT incurred on that will be exempt input tax. So that's 2 categories: taxable input tax, exempt input tax. Then there's all the VAT on cost that doesn't fit solely into one of those categories. And this could be the majority of VAT incurred by a club, with the exception of wet bar purchases. So these will be on overheads, things that relate to all the activities of the club. So a generic cost, clubhouse cost, utility bills, things such as pay TV subscription, kit bought by the club where there's a sponsor's logo, relates to both the exempt playing activity and the taxable sponsorship income. So it's a partially recoverable overhead cost. Pitch and ground maintenance cost will invariably be an overhead cost. Where the pitch is used for taxable purposes, i.e. a taxable let invariably or a gate admission. If the pitch isn't used for those circumstances, then the ground maintenance cost will solely relate to playing and will be an exempt input tax cost. And other central overheads. So we have 3 different categories of VAT on purchase: taxable, exempt, and overhead. What we need to do is establish how much of the VAT on overheads can be estimated or deemed to relate to taxable, and how much of it should be estimated or deemed to relate to exempt. And this process is very straightforward. It merely uses a calculation based on the income of the club in that year. So the equation is shown on the screen: taxable income over total income, and the taxable element as a percent of total is the percent of the VAT incurred on overhead cost that is estimated to relate to the taxable activity. So in our example here, we see taxable income of the club is 75k. That's generated from bar, catering, function hire, merchandise, ticket sales, etc. And the exempt income of the club is 25k, player subscriptions, match fees, and a few fundraising events. So of the total income of the club in that year of 100k, 75% is taxable. And that's a typical range. Normally clubs will be in the range of about 60 to 90% taxable, depending on the specific circumstance of that club. So we use that then to split or portion the VAT that's been incurred on the overheads. So in this example, the club has incurred input tax on cost, 20k, input tax on exempt cost, 1500, and VAT incurred input tax on costs that don't relate solely to either taxable or exempt and can be called overheads of the club. That's 12k. So our taxable input tax in this example will be the 20k directly attributable plus 75% of the VAT on overheads, the 12k. So we therefore get a total taxable input tax value for that club for that year of 29,000. And the VAT rules enable us to recover that VAT automatically. So it's VAT relating to taxable activity, so directly relating, but also indirectly relating as a proportion of the overheads. So that 29k is in the bank, it's secure, that's automatically recoverable. The exempt input tax is the VAT on directly attributable exempt cost, £1,500, plus the remaining proportion of the VAT on overhead, the 25% of the 12k, and that comes out to 3,000. So our total exempt input tax for this club for the year is £4,500. That's not automatically recoverable until we apply what are termed as the partial exemption de minimis tests. And this effectively is HMRC saying the value of exempt input tax is so small that we will let you have it back. We will overlook it. So in our example here, the £4,500 is below the two tests. The two tests are that the exempt input tax is no more than £7,500 in that year, and also that it's no more than 50% of the total VAT incurred. So if we go back to look at the VAT incurred by the club, clearly the taxable input tax, being the wet bar purchases primarily in the international tickets, will usually far outweigh the exempt input tax. So that 50% test is invariably not a problem. The issue is the 7,500. In most normal operating years, most community clubs will stay well within that. And it's only in years where there are facility improvement projects where this potentially will become a problem, because clearly far more levels of VAT are being incurred, and any sizable project will, a proportion of the VAT incurred on that project will tip most clubs over that 7.5k allowance. So the issue is most clubs can recover all the VAT they incur as a general rule, with the exception of years when there's a facility improvement project where the VAT incurred by the club greatly increases, and therefore the exempt element of that VAT, the 25% in our example, tips the club over the 7.5k exempt input tax allowance, and therefore all exempt input tax becomes disallowable. So the happy position normally is most community clubs are able to fully recover the VAT. Unfortunately, the COVID closures have caused us problems in that happy position, in that the reduction in taxable incomes have, in line with exempt incomes not being so impacted, a lot of subscriptions are paid by direct debit and they've maintained, have swayed our calculation from being 75-25 typically to resulting in the exempt income of the club being a far greater proportion of the total income of the club. And clearly that has an impact on our VAT recovery calculation. So just to draw a comparison, in a normal year, 75% of income would be taxable in our example. In the last year, or the current VAT year, which has been impacted by COVID closure, we see in our example, the income of the club has dropped from 100K down to 40K. The taxable element of that is merely 10K, maybe some sponsorships or some minor incomes have come in. But the important figure there is that the percentage of taxable income as a percentage of the total has dropped from 75% down to 20%. And this I'm seeing is a very typical example of a material drop in the taxable percentage of total income of the clubs. The problem, as you will see, is that this reduces the ability of clubs to recover VAT on cost. This is particularly a problem where a facility improvement project is involved. So under a normal circumstance, where projects are under 250K net cost, the VAT recovery is dealt with in the year that the cost is incurred. So if a club, for example, this year was building a clubhouse extension costing 200K, the VAT incurred of that of 40K would be the recoverability of that would be determined in the year the project is undertaken. So in this current year, if COVID closure has caused us to have a greatly reduced VAT recovery level, then potentially the cost can be quite dramatic. Similarly, with projects over 250K, there's a special VAT scheme termed the capital goods scheme. Under this scheme, clubs initially recover the VAT in the year in which the cost is incurred, so this year. And then after that, there's a 10-year review of the use of the asset to determine the ultimate level of VAT recovery. So again, it's the initial rate which is all important. So the rate this year, and if that's greatly reduced by COVID, that's going to cause a real problem. To put that into context, we'll just skip that one for a second. Put that into context. In a normal VAT recovery year, if our typical club is getting a recovery rate of 75%, then the VAT on a 48K would be 36,000. So 75% of 48K on the project would be 36,000. However, if this year our VAT recovery rate has dropped from 75% to 20%, then our VAT recovery is plummeting to 9,600, which would be a real loss of 26,000. So you can see there the problem which arises, particularly if you're involved in a project this year, that your VAT recovery could be absolutely decimated through no fault of the club, but as a direct result of COVID closure, reducing the taxable income of the club in the current year. What clubs need to do to overcome this problem is that they need to apply to HMRC for what is termed as a partial exemption special method. This shifts the basis of the calculation from being related to income generated in the current year to a VAT recovery method based on what HMRC would call use. So rather than assessing it on income, you would assess the use of the asset, i.e. in this instance, the use of the clubhouse. Clearly this year is not representative, so it would be unfair to base your VAT recovery on the income generated in the current year. So some measures of use that I've seen HMRC accept would be, for example, to use last year. So if last year the VAT recovery rate was 75%, then you could apply that equally this year. Or if that was COVID impacted last year, then you could use the average, say, of the last 4 years. Or particularly if you're increasing your social facilities as part of the project, you may want to use what's termed as a projected income basis. So project what the levels of income the club will be once the new facilities are all up fully and running. So all of those I've seen accepted by HMRC and shouldn't cause a problem. But that will get the club back to par. It will get it back to proper VAT recovery rate that truly reflects the activities undertaken by the club. So a few key points on this. There are partial exemption special method forms that must be used. There's an information form that's not dramatically complicated, but it does require a lot of detailed financial information. You need to send your last set of accounts with it and explain why you believe the current VAT recovery rate is not appropriate, and draw a comparison, draw out in the form a comparison, say, between last year's rate and the current rate this year, maybe for the first 9 months of this year, to show that your VAT recovery has dropped. And if you're currently involved in a facility improvement project, then you need to say that's particularly harsh upon the club and you're not being able to generate a fair and reasonable rate of VAT recovery. You also need to provide a declaration which says that the proposal you're making is a better reflection of the use of the facilities, and therefore it's made on a fair and reasonable basis. These need to be sent to HMRC. They will accept them by email now. They've set up a dedicated email receipt point for these partial exemption special methods because they're expecting a lot of people to be putting in for them. The key is, though, that these have to be sent to HMRC by the end of your current VAT year. Your VAT year will either end March, April or May, the end of March, end of April, end of May, depending on when you submit your VAT returns. So if your VAT returns, if your current VAT return covers the period January, February, March, your VAT year as a club ends 31st of March. So the key will be to you that you need to submit that application for a special method by the end of 31st of March. That's important because if you send it in after the 31st of March, you're then getting into applying for a retrospective special method, which causes a lot of technical difficulties. And we don't know if HMRC are going to be relaxed in their approach on this because of the current circumstance. So my advice would be get it in by the end of March to be safe. If your VAT periods end April, by the end of April, and similarly by the end of May. So that's a relatively straightforward process to overcome the damage to your VAT recovery that COVID closure has caused. And I would encourage you, particularly if you've got a facility improvement project, to make your application, and it gets you back to par. So if you would like any further information on this, and I appreciate it will be quite a complex issue for a lot of clubs, and particularly if you're worried about VAT you're currently incurring on a facility improvement project, please do speak to me via the RFU VAT helpline, and my contact details are there by email or by phone. If it's complex, I particularly encourage you to do it by email because I can get my head around it and give you a call back or an email back. And similarly, if you would like me to complete the special method application forms for you, I'm happy to do that. And I've agreed with the RFU a fixed fee of £250 to do that. So I'd encourage you either use myself or your professional advisors, but do submit your application in time. And I would encourage you to get professional advice on it because that will ensure that your application finds a smooth path through HMRC. Though they are approving them, it's only if you provide incorrect information or incomplete information that you're likely to get a hiccup. And just to reiterate, you need to do that by the end of your VAT year. That's a very important point. If you don't, there's no guarantee HMRC will accept it. So just a summary of the key points made in this little talk. COVID has unfortunately caused a reduction of taxable incomes, and the impact of that on rugby clubs has been a reduction in the ability to recover VAT, a potential reduction. This will particularly be true if you've recently undergone in the last 12 months incurred cost on an extraordinary cost, such as a facility improvement project. Or if in the last 10 years you've had a project that was costing net 250k or more, you're still in your capital goods scheme 10-year review. And similarly, even if it's 9 years after the time you undertook the project, you may suffer a VAT loss now under this capital goods scheme annual adjustment that's required. If you are involved in a capital goods scheme, I would recommend you get advice on that if you're not confident on it, because again, it could trip you up unintentionally. And the key message is apply for a use-based special VAT recovery method that will enable you to use either last year's method, maybe an average of recent years, or a projected income basis, as this will get you back to par, back to where your VAT recovery should be. And apply to the HMRC by the end of your current VAT year. I cannot emphasize that enough. That is vitally important to avoid any potential hiccup. And that is the end of this VAT talk. Thank you for listening, and would encourage you, any issues, please do try and contact me on the VAT helpline. Thank you.